Hello traders, today we are going to go over another candlestick strategy. In this case it's called Three Black Crows strategy. It's a popular trend reversal strategy used by many traders to identify when market is turning down. This is a pattern that can only be used when we identify an uptrend, which means that ultimately we are looking for an uptrend to turn into a downtrend. So the first step to identify this pattern on a chart is you are looking for an uptrend. Here we have a clear uptrend, we create a new high, and then as a second step we must find three long and bearish red candles in a row. So three consecutive long bearish candles, and in this case it's four, so the more the better, and these four candles actually only just add more strength to the reversal pattern. The third rule is not so important as the second one. The second one is a must, of course, that we must have at least three long red candles, but the third rule, it says that the candles have small lower wicks, so these wicks should not be long, for example, as this one. Look at this long wick, which means that the price should close near the lows that created. What happens here is we have an uptrend, we have four long candles, we close at the low. This is an indicator to the traders that the market is reversing, and from bull market we are entering bear market, and then you're into a short sell the rallies form, and then you look for any rally to sell and look for the new lows. This is a dollar yen daily chart. It is important to say that this strategy is mostly used for long-term traders, since we are looking for a confirmation that the upward move has ended, and then we are entering the down move. Of course, sometimes it's only a short-term move, sometimes it's much longer. In this particular case we are talking about a huge downward move that more or less results in a 1200 pips from this high to this low. Second example I want to show you is a euro dollar daily chart. Again, clear uptrend. This is a very good example because here you also have this uptrend, three red candles. However, look at the candles, these are not really bearish candle, this is more indecision time for traders, hence this is not the pattern that we are looking for here. It can also be you can say that this is a pattern that we're looking for, so it's an uptrend followed by three red candles. However, we want to find at least out of these three candles, at least two must have long bodies. Here this is not really a long bearish candles. And then finally we have 1, 2, 3, and out of these three we have two extremely long red candles. Look at the first and the second one. Only the first and the second one are 300 pips move candles, so the price fell down 300 pips in 2 consecutive days, which meant that we are now looking for the bears to have control, and we are looking to sell any rally, and this is actually what happened. Look, we created the low with the third candle, we had a slight correction, but the correction was sold 2 times immediately. You see 2 long upper wicks here in these 2 candles, and then we create a new low. So from this high to this low we are talking about 600 pips move. Again, this pattern works best at on the higher time frames, at least daily. So we're talking about daily, weekly, sometimes even monthly. And the third chart I want to show you is a chart on a weekly is a price action on a weekly chart, an uptrend. Here we have 3 long candles, bearish candles from the top. We try to recover, but simply these 3 bearish candles are too much to handle for bulls, and this gets sold. So from this slight recovery at 126, we push down to 125, 122.50. So we push 350 pips lower. So we are integrating this into our daily trading plan simply by saying, okay, we have reversed, we are not buying dips anymore, since as we did in the uptrend, but actually we are selling the rallies. And here, if you sold this rally because the price corrected from 123.50 to 126, you could have earned some very good profits.